Hello everyone, how's it going? In today's video, we're going to be talking about Mullen, trading under the ticker symbol MULN. So currently, the market remains very volatile with significant downward pressure, mostly due to international events, interest rates, long due recession, in my opinion, and a significant change in people's behavior in terms of where to allocate their capital, especially compared to 2020. So Mullen has attracted people's attention because of essentially three things. Number one, it's an EV company. EV has been a magic word ever since Tesla took off. Okay, that's the first thing. Number two, it's very cheap. It's a penny stock at the moment. Number three, it can be very volatile. Personally, I have owned Mullen shares at one point, and over a couple of weeks, in terms of percentage, I think I've made 117% of gain, and then I exit the position. Of course, in terms of total exposure, I think it was less than $100 back then because, and we might talk a bit more about this later on, because this is the total amount that I'm willing to risk for Mullen, as far as I'm concerned. It doesn't mean that your risk tolerance should be at the same level of mine. Essentially, $100 is 1% or 0.5% or 0.25% of my portfolio back then. So essentially, yeah, for those three reasons, Mullen has always been very popular. In terms of the fundamentals, it could have been served as a fourth element, but I would say that this part, number one, at the moment, it doesn't really play in Mullen's favor. And number two, we don't know who are the commercial partners. We're going to talk about a little bit of the recent news and so on, but we really have to keep that in mind, which is we don't know a lot of things about Mullen's operations, who are the commercial partners, and we would have to work with this kind of lack of transparency if we're going to go forward with Mullen. Now, another factor that can be very attractive as well is that Mullen seems to have its own price dynamics. It doesn't just follow the market. So especially now, given that the overall market is, very down, the fact that Mullen follows his own course of actions can be a very interesting fact as well. Now, the short-term price resistance is around $1. And this could really go significantly higher if it is reached and maintained over time, because it's not only a psychologically important level, but also because the $1 level is required to stay listed on the NASDAQ. A lot of traders, especially institutional ones, they don't trade the pink sheets ever. Whether they are, whether they find this company interesting or not. In fact, even a lot of retail traders don't want to put a lot of money into pink sheets. If you follow my channel, or if you've been following my channel for a long time, you would sometimes notice that when it comes to OTC stocks, usually I don't recommend to put in more than 1% of your holdings. So if the $1 and $3 levels are reached, then we can realistically hope for the $10 level. Is that going to happen in the short term? Probably not. But it also depends on how you would define things. Because for a stock like Mullen, with very few or no institutional participation, I think that things can go very quickly. So the likelihood is significant because of the momentum. There's the speed, then there's the momentum. So the speed is something objective. Okay, are things going fast? This is one thing. The other thing is the momentum. Do you feel that there is a grassroots movement bubbling up? If there is, then we can always hope for miracles, because miracles have happened before, not only for pink sheets, but for Mullen as well. Like I said, last time I owned Mullen, it doubled in less than 2 weeks. The speed that it can happen can be very quick as well. It has a volatile shareholders base, which is very speculative in nature and without much institutional participation, if any, last time I checked. This kind of shareholders, and by that I really mean ourselves, okay? Retail shareholders tend to buy in and out because they want to grab on like a piece of the action. They want to jump on the gravy train. The institutional money, on the other hand, tends to be more longer term. It doesn't mean that they're going to stay for like years, but they're going to stay at least for a few months. And they tend to trade less frequently. The retail, on the other side, tends to be a lot more reactive, active, and impulsive. So they like to trade, in and out of places. As soon as rumors hit or as soon as the results hit, you're going to see a massive pileup of either like buy-in or sellouts. And right now, it's certainly going to hold, we know that for sure, it's certainly going to hold the 25 cents level, okay? But the real question is where it can rise to with the current price action. Of course, no one knows for sure, but it can be significant. Now, today is a bit of a bad example because it didn't rise much. In fact, it even went back a little compared to the Thursday closing price. But if it doesn't go through the $1 level, this can realistically trigger a retracement or, just slagging around. It can possibly go back to the 50 cents level or even test once again the 25 cents level. Like we don't know. But it remains to be seen within a week after testing like the $1 level to see if any additional steam can be gathered. In my opinion, yes, because of something other than the fundamentals. We're going to talk about the fundamentals in a second, but also the something else. So in terms of the fundamentals, the big news is that Mullen has obtained the distribution right of a small electric vehicle called iGo in Europe. It's a small, compact, Volkswagen-like vehicle, which is apparently designed for last-mile deliveries. In other words, Uber, Amazon, taxi, that kind of stuff. And it's kind of smart because not only, like at some point, I was interested in the world of Uber Eats. I wanted to see what kind of cars are really made for this kind of stuff. Number one, it's fuel saving capacity. So whether it consumes very few liters of fuel. And given the current events, it's kind of even more relevant as well. Number two, is it cheap? It is. It costs about 12k euros. So this is very, very low for an EV, right? Number three, is it small? Is it compact? Because streets, especially in Europe, could be tricky to drive through. So iGo kind of ticks the boxes for all three. So on paper, things look very well. Now, the other thing is, there are a lot of suspicions that this car is not Mullen's invention. It's probably some sort of cheaper EV manufactured elsewhere that Mullen wants to slap its own logo or its own brand on it to start commercializing it. There's nothing wrong with that, but, I would say that in this kind of good news, don't look too much into the objective news. Remember I mentioned like you should look at the momentum. I don't know how much about the speed of things. Because if you really want to say, well, is that such a good news? An EV company that's supposed to take over the world with its own creations to rely its future mostly on like distribution deals of cheaper cars. So, it really remains to be seen. Not to mention, the European economy is going through some rough patches. And who knows how long they're going to recover. And, if they're going to recover at all. Because don't forget, a part of it is currently at war. right? For example, if we take Germany as a place to as a reference point, well, you would think that Germany is a stable country, right? Well, yeah, obviously it is. Who's the neighbor of Germany? Poland. Who's the neighbor of Poland? Ukraine. So, I mean, there you go. Obviously, I don't have like hidden information on whether this is going to be like a disaster. I'm just saying that the instability brought by war is a lot closer to home if you want to do business in Europe. Okay? Not to mention that in this year's winter, unless, thanks to global warming, thanks in quotation marks, of course, but if we have like a super warm winter, then things might not be as bad as they sound like. But if not, there might be a winter of grave discontent. So this is the first thing. You know, it's a mitigated but massive good news for Mullen. I would say that some people are have probably been looking for a good news to justify a buy-in. So this might be it for them. That's one thing. The other thing is a short squeeze. So a short squeeze is essentially the act of buying up a share, forcing the short positions to be redeemed and to act as a second push for the share price. It worked very well with AMC. It worked very well with GameStop. But of course, this kind of stuff is trading centered, is speculative centered. Nevertheless, it's a very strong catalyst to encourage people to buy Mullen when they see that the momentum might be picking up. Because as far as the short selling percentage is concerned, is significant. They have about a quarter of their volume coming from the short positions. Normally, if there's more than 20%, there's a case for short squeeze. Especially, and this is like why I believe that now is a good entry point, especially when the stock goes higher. Because as far as the short sellers are concerned, their shares are borrowed. They have to pay back the shares at some point, meaning they have to buy back those shares at a later date, hopefully when the share price falls lower. If it doesn't happen, then they would have to buy back at a loss, because in the meantime, they're incurring financial fees every single day. When I was trading currencies, I used to have short positions because I thought that this is cool. You know, I felt like I'm George Soros. But you would incur like little interest fees every single day as long as those positions remain open. And by the way, you're still betting about whether this pair of currencies or whatever asset that you're having will go into one direction or the other. Except in this case, yes, you're making money because of some bad news with this company or the market, but at the same time, you're paying financial fees for it, right? So people might be more reactive and alert to negative price changes. If, in this case, Mullen's price goes up, they would be forced to liquidate their positions at some point. And by doing so, this acts as a second push for the price action. So the institutional holders at the current point, I think it's either zero or very negligible. And the shareholders of the company are mostly in for the short term, I think. The company is being still too volatile and lacks a little bit too much transparency for my taste to allow us to have a clear idea about any long-term future. The current spike is probably due to the IGO distribution, and I believe that it can also have the potential for an even larger takeoff because of the short squeeze. Okay, the investor profile that can buy into Mullen should believe into the long-term future of EV. They don't have to believe into like the long-term future of Mullen, but they should at least believe that EV is here to stay. They're comfortable with short-term trading, especially short trading and not short trading, but like short-term trading penny stocks, they have a lot of diversified holdings in different sectors, and they can afford to incur heavy losses on any single positions. And in this case, well, on Mullen. Imagine your position has gone down like 50%. Can you stomach that? If the answer is yes, then press on. So my recommendation is that you should probably start buying now, and to buy a significant chunk of the allocation, as it seems to be an inflection point within the price action right now. With a short squeeze and like the iGold distribution deal, and to hold it for maybe 3 to 6 months before considering to realize any gains. The exposure that I would recommend is about 0.5 or up to 1%. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach. which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.